This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial. Today we're going to talk about opportunities within the market when there's a correction that's needed. You may not know what that means, neither do I, but I'm going to speak with Caleb Doane, the Vice President of Foster Financial. Hi, Caleb.
Hi.
How are you doing?
Doing well. How are you doing?
Good. Okay, so I'm so curious about this topic. What exactly is a market correction?
Yeah, so it's typically designed as a 10% drop in the market from a recent high. So they're not good things, right, if you're an investor, but it's something that is relatively common. We kind of prep investors for this. We typically see it every year or two. It's not uncommon to see, especially with the level of growth that we've seen in the market over the past few years. So it's certainly something that can scare clients if they see that, hey, the market has dropped 10% over the last month. We just experienced one a couple weeks ago.
Yes.
And so it always is a little concerning for clients, but it's something that we help them through. And there are even some opportunities that present themselves when we do see market corrections like this, especially within tax strategizing.
Okay, well, right now is definitely the right time to talk about it. If anyone has been following the news in any way, the market has just been whoop, 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 whoop. So, and that affects everyone. Like a lot of times people think like, oh, you have to have a lot of money in the stocks for this to impact you. But really, if you have a 401k, if you have any type of investment, you may be impacted. So how can people really save money in the long run dealing with these inflation up and down?
Yeah. So with all the kind of market corrections that we've seen, we've talked previously about how, Roth conversions, it can be advantageous to do those when the market is down. There's tax loss harvesting opportunities. The one I'll talk about today is a little different. It's with a specific type of investment vehicle called a non-qualified variable annuity. So there's lots of words there, the variable basically means it's invested in the stock market. The non-qualified part means that it was originally funded with after-tax dollars. So money that's already been taxed, it was just sitting in your checking account, let's say, and you put it into a variable annuity. The maybe issue, I guess, or the tax issue that those accounts can sometimes cause is that they don't have as great of tax implications long term. So all the growth on non-qualified variable annuities gets taxed at your ordinary income tax rate, which is higher than the capital gains tax rate. So if you're in the 22% ordinary income tax bracket, you pull money out of the non-qualified variable annuity, that growth is taxed at the 22% capital gains rate, whereas if it was in a different account, like a stock brokerage account, it would only get taxed at 15%. And so when we see the stock market come down like it has done, it can be a good opportunity to reposition out of a non-qualified variable annuity and into an account that's more tax advantaged.
Okay, let's take it back for a second. So an annuity. Okay, let's start with the annuity and then kind of work backwards with all of those terms.
So the annuity, it's just an investment vehicle. It's a tax-deferred investment vehicle. Variable is just that it's invested in the stock market, and then the non-qualified is that it's after-tax dollars. So they're relatively common investment vehicles. And so we see them very frequently, but a lot of times people don't know the tax implications for those aren't as great as some other investment accounts.
And how would someone find themselves in one of those accounts? Does it have the parameters such as the age range or retirement range like other retirement accounts has?
Yeah, those typically don't have a lot of the same rules that some of the other accounts have as far as how much money you can make to contribute to one. So it's relatively common to see people
any
with
age?
No, any age you can get into them. There's only certain ages that you can withdraw from them without penalties, so it's similar to retirement accounts in that manner. But that's one of the things that we take a look at for clients is we see, is this account in the long run going to save you on taxes or going to cost you more in taxes? The other big thing about those non-qualified variable annuities is that they don't get a step up in cost basis when somebody passes away. And so basically it means that beneficiaries will have to pay the taxes on the growth in that account when they inherit the account. So they're going to be on the hook for the taxes, whereas with other accounts that we use, like a stock brokerage account, for example, it gets a step up in cost basis, meaning the beneficiaries get that money completely tax-free, even if there was growth on it.
Right, because you said the non-qualified part of that term means that it was pre-taxed.
It had already been taxed.
So tax fund. So after you receive your income that's been taxed, then you contribute to it.
Exactly.
But you're saying that part of it is okay. Once you get it inherited, it's only the gains on it that one would have to pay taxes. I'm assuming at their own tax bracket or something if they did inherit it.
Exactly.
Okay.
Whereas with other accounts, like a stock brokerage account, they get the cost basis and the gain. It comes out tax-free because it gets the step up in basis at death. So yeah.
So if we're talking about long-term or someone saving money with a market correction, are you saying that the non-qualified variable annuity is a good option, or are you saying there are better options?
Yeah, there's better options.
Okay.
So yeah, the non-qualified variable annuity, when there's a market correction, of course the gain in that account goes down, right? Because the stock market goes down. And so then you're paying less in taxes to pull money out of it, to therefore reposition into an account that is going to save you more on taxes in the long term, both you and beneficiaries. So that's one of the things we like to take a look at as an opportunity when the market drops here, especially if we anticipate a recovery.
Okay, so you said that there's a few more we're going to continue to talk about in an upcoming week?
Yeah, absolutely.
And then last thing, Caleb, so is another good option to go with a fixed stock option so that you're not really implicated by the ups and downs of the market?
Yeah, so it depends on the client's risk tolerance, of course. It depends on a lot of things, but the variable products over the long period of time historically have significantly outperformed the fixed products.
Okay.
But of course the fixed ones, they are a lot safer, right? And they, aren't subject to these market corrections. So it's the old adage of, more risk, more reward on the accounts. And a lot of times people need a little bit of both in their portfolio. You don't want to be fully aggressive, and a lot of times maybe you don't want to be fully conservative either, so that you can still keep up with inflation and things like that.
Okay, well thank you so much, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their phone number listed below. You can give them a call for a complimentary consultation, and I'll see you after the break.
This segment sponsored by Foster Financial.